If you have not heard yet, Silicon Valley Bank, or SVB, collapsed over the weekend. News of this collapse has already set off panic and confusion across Wall Street, with many people wondering about the implications this will have on tech startups, particularly those that are in early stage. Many people, especially working in these smaller startups, were obviously concerned and reached out to me over at Instagram to ask me for my take on this situation. While I want to be clear that I do not want to speculate on anything and add to this fear, I do think it's important to understand exactly what happened. So in this video, I will explain what happened to Silicon Valley Bank and what that means for the tech industry, especially the startup sector. All right, let's get started. So to provide some context, Silicon Valley Bank was used by almost half of all venture-backed companies in the US as well as many in the UK. Therefore, the repercussions of its collapse are significant. On March 8th, 2023, SVB announced its latest earnings and revealed that it had suffered from a slowdown in venture capital funding, some decline on customer deposit volume, and also losses on investments it had made. And as a result, it was going to sell off some of its assets to meet the demand for customer withdrawals. This news set off fear in the tech industry, which started a bank run that led to the complete shutdown of the bank in less than 48 hours. You may be wondering what a bank run is. Well, a bank run is basically a situation in which a large number of customers of a bank or any other financial institution withdraw their deposits simultaneously due to concerns over the bank's solvency. And this can lead to the bank's failure if it's unable to meet the demands of its depositors. To be honest, all banks are exposed to what is called an asset-liability mismatch. This refers to a situation where a bank's liabilities, like customer deposits, can be withdrawn on demand, but the bank's assets, which are typically longer-term loans or securities, might not be liquid or fluctuate in value. Banks generally invest in longer-term loans or securities to generate income to pay for its depositors at least some amount of interest while earning a profit on the spread. However, banks do not invest all of their customer deposits in longer-term loans or securities. The aim here is to maintain enough liquidity to meet potential customer withdrawal. But the main problem with Silicon Valley Bank, or SVB, was that the lack of diversity in its customer base. Most of its customers were venture capital-backed companies and startups. So when the stock market and private equity markets went down last year, many of these firms didn't try to get newer loans and instead used the money they already had. This meant that there were more customer withdrawals, at least more than expected, that were taking money out of SVB. And the bank had to sell some of its investment for less money than it paid for them. This scared people who had money in the bank, so they took even more money out, and things went from bad to worse when a few important venture capital firms, like the one led by Peter Thiel, told their companies to take the money out of Silicon Valley Bank. A large venture capitalist firm can have hundreds of companies under its portfolio. So a message like this can send many companies into a withdrawal frenzy. Unfortunately for a bank like SVB, once the panic sets in and more people join the fray, it's almost impossible to control. It's like a small snowball turning into a massive avalanche. And sadly, that's exactly what happened. By midday on March 9th, the bank's systems were completely overwhelmed by customers requesting to withdraw their money to a point where people were not even able to log in. And by the end of the day, SVB had processed over $40 billion of withdrawals. And sadly, by Friday morning, the bank was permanently closed. So SVB went from being one of the largest banks for venture-backed companies and startups to being out of business in less than 48 hours. So people or companies who got their requests in early for withdrawal were able to get their money, but for a majority, the question is still whether or not they will actually receive 100% of their money, and even if the answer is yes, by when. I am recording this late Sunday, and so far the FDIC, Federal Reserve, and the US Treasury have jointly announced a plan to guarantee deposits of all sizes. This is mainly probably to try to prevent a contagion risk where a widespread panic happens and even other banks potentially face the same fate. Well, so far, the US economy has powered along with record employment and strong growth, even as the tech sector has gone into a massive slump. So hopefully hopefully this will just be a one-off situation and does not set up a widespread panic leading into a much larger economic crisis. And I know there are people drawing parallels to the 2008 financial crisis, but I don't believe that such a comparison is warranted or even correct in this situation. Leading up to the 2008 financial crisis, banks gave out risky, interest-only, adjustable rate mortgages to people with low or no credit history. These borrowers wanted these loans mainly because they thought they could refinance before they had to start paying off the loan. And then most of them also hoped to make money by selling their house for more than what they paid for. But when they couldn't refinance, they couldn't pay their loans either. And then banks had to hold on to these bad loans because nobody else wanted to buy them. And then the Federal Reserve had to step in and buy all of them. But right now, no bank really gives out these bad loans. Some banks may have to sell assets to meet customer withdrawals, as the case with SVB, but that's just due to how the economy is shifting. But that's normal and shouldn't be considered anything drastic. This is completely different from what happened in 2008. In fact, as the equity markets panic, the interest rates have actually fallen and the treasury prices have gone up. So this may just be a self-correction and may actually help the banks recover. That being said, I'm not a financial professional, so please do your own research. What I can opine on is the impact this will have on the tech industry. Regardless of whether there are greater implications because of this or not, this is obviously a massive hit for the US startup sector. Most early stage startups will struggle to make payroll and infrastructure costs, especially if they don't recover their money right away. I've been a tech founder myself, and back in 2015, our company was valued at around $5 million with venture-backed initial seed money of around $750,000. Four of us were co-founders, and none of us were taking any salary at that time and had not done so for many years. Our plan, however, was to invest the seed money into hiring 2 full-time software engineers and spend the rest on product infrastructure like cloud costs and on go-to-market strategies. And I know this from first-hand experience that even just 2 entry-level full-time software engineers can cost up to $400,000 to $500,000 a year when you factor in recruitment, compensation, and benefit costs. So I can only imagine the absolute panic and hopelessness I would feel if the bank that held my company's seed money was suddenly closed. Questions like, how would I pay my engineers next month? How would I run campaigns to push the product? How would I pay infrastructure costs? Would be just devastating. It could have completely killed the company and probably destroyed all of our dreams. And sadly, this is the exact same headaches that startup co-founders and leadership will be facing in the aftermath of this event. Most early stage startups, like I said before, will struggle to meet payroll and infrastructure costs, especially if the FDIC isn't able to give them their money back right away. So let's address the elephant in the room. What should you do as a software engineer if you work in an early stage or even late stage startup in the US right now? Well, if you've been paying attention, you've probably picked up that a lot of this could have potentially been avoided if people, and in this case specifically VCs, didn't panic. So my advice to you is exactly that. Don't panic. The tech economy has already faced a few blows since 2022, and now this has caused major ripples in the tech startup sector. The last thing you want to start en masse is a job migration in tech. Look, the reality is that your startup might already have diversified its cash reserves in multiple banks or is in the process of doing so. And maybe the FDIC will ensure everyone gets their cash back right away. Just keep an eye out on the news, ask your leadership to be transparent, and if you have the financial means to weather this storm, have faith in the company and its founders. You joined the company in the first place because you must have believed in their vision, and this hasn't changed that vision, right? So my suggestion would be to keep that belief. So in summary, while it is important to understand what exactly happened with Silicon Valley Bank and its implications for the tech industry, mainly venture-backed startups, it is also important to avoid panicking. So at least for now, stay calm and carry on. That's it for today. I'll see you in the next one. Cheers.